Coming up on the SBS on the Money podcast, Brent crude spikes to above $80 a barrel following US strike on Iran. We'll take a look at the petrol price impact and how the markets have reacted. That's all next. Hello everyone, it is Monday the 23rd of June 2025. The Australian share market falling today by about 0.4% on the S&P ASX 200. It was worse than that earlier in the session, and I'll have the details with Raymond Chan from Morgans in a few moments. But first to Brent crude oil, jumping above $80 at one point today as investors react to the US strike on Iran's nuclear sites at the weekend. For that and more, I spoke with Robert Rennie, the head of carbon and commodity strategy at Westpac.
Well, look, financial markets have actually been relatively well behaved. The biggest move in markets that we've really seen has been in crude markets, and that made sense. When I saw those headlines coming out yesterday, I expected Brent to open somewhere between $80 and $82. Now, the fact that it has done so, and actually since then, I mean, we would have opened up about 5% on the open this morning. And you've got to remember here that we were up about 22% month to date. So the fact that Brent has opened pretty much exactly where I expected it to be, and actually has since, just looking at my screens just now, has since dropped back below $78. That suggests traders are taking a very mature view over the weekend's events. Effectively, we're viewing this as a very targeted strike that critically damages Iran's nuclear capabilities, and hopefully it brings us closer to peace in the region.
Is it fair to say that the biggest implication would be what happens with the Strait of Hormuz, right? And the fact that the passageway is still open at the moment, traders are looking at facts rather than what may happen in the future. Still, though, can you explain how important that strait is?
Yeah, look, simply, I mean, the Strait of Hormuz, so that's Iran in the north, and then the UAE and Oman in the south. So it's a very narrow body of water. And that's critical to the transport of energy markets globally. I mean, there's recent estimates that more than a quarter of total global seaborne oil trade passes through that very narrow strait, and around about a fifth of global liquid natural gas. Now, very importantly, and this is where it becomes very important from an Australian point of view, China, India, South Korea would account for about 70% of the crude oil and condensate that actually flows through the straits. So it's critically important for Asia, and given that we rely on Asia so much for our condensate flows, it's obviously very critical for Australia as well.
I've seen some analysis from other banks. Goldman Sachs, for example, was saying that if there was a 50% reduction in flows for 1 month and then a 10% reduction for the rest of the year, for the next 11 months, that those Brent crude prices could reach 110. Is that possible?
Look, anything in the current situation is possible. And I think if we certainly saw Strait of Hormuz closed for an extended period of time, we'd certainly be looking at significantly higher prices. And Brent at or above $100, I think it seems eminently possible in that situation. I view it as very unlikely. The US is moving battle carriers into the region. There are significant forces. We've got to remember that this body of water is actively patrolled by the UK Navy, the Indian Navy, to name but a few. There is significant amounts of hardware in the region, which potentially would be brought to bear if we saw Iran moving to close the Straits of Hormuz. Now, the Iranian parliament over the weekend did vote in favor of it, but we have to remember that it's the supreme leader, it's the IRGC that makes the decisions here. So clearly markets are going to be watching developments very closely in the days, weeks, and months ahead.
And what has history shown when it comes to this area? Has, for example, that strait ever been closed? And what kind of activity are we seeing recently?
Oh, look, certainly we've seen Houthi rebels, for instance, actively targeting vessels in the region. At the beginning of this week, there was significant evidence of jamming of positioning radar and navigation systems, we actually saw a collision between two vessels at the beginning of last week, which looks like it was actually caused by jamming emanating from Iran. So there's very little doubt that activity and passage through the straits and indeed the Gulf will be being impacted at the moment. Again, if we see that actually we get into a situation where Iran tries to militarily the Strait of Hormuz for an extended period of time, that would be an enormous event for energy markets. But at least for the moment, we are actually seeing some signs of passage being slowed as a result of the developments over the weekend, and obviously the events coming up to the what we saw taking place on Sunday.
And final question is the what about me question. What does it mean for me? When it comes to our oil prices, the thing you think instantly is petrol. So what's the
Yeah.
implication for motorists?
Look, my measure of fair value for what I call terminal gate prices, so that's the wholesale price that we actually see at terminal gate. That fair value would have risen by about 22 cents so far this month. Now, the actual terminal gate prices have risen by about 13 cents. Now, we have to remember that there are a lot of lags involved here. This lags, it takes place somewhere between a week and 4 weeks. So it does take time for that terminal gate price to rise and for it ultimately to be passed on to consumers. I would say it's probably fair to say that retailers have actually been quite quick to respond to developments. So prices have risen. But you would certainly be expecting the price that we pay at the pump to rise by somewhere in the region of sort of 15 to 20 cents through this month. And obviously, now is the time to get out there and use those apps and look for better deals because better deals are definitely available.
That's Robert Rennie there from Westpac. Now, Market Day on the SBS On The Money podcast. Let's take a closer look at how the share market reacted because the S&P ASX 200 was down early in the session. It made up some of those losses towards the end of the afternoon, with the index down 0.36% to 8,474. With the details, I spoke with Raymond Chan from Morgans. Raymond, first of all, just how worried are investors about this rising tensions in the Middle East?
Well, there's two types of investor. There's share investor and there's bond investor. Right now, we're seeing a disconnect between share and bonds. The stock market is looking confident with equity risk premium trading near record lows, which suggests investors are feeling quite relaxed about the whole situation. But the bond market is showing more concern with the US 10-year bond yield tracking higher, actually at a much higher level. In the face of all this Middle East tension, also another thing we have to be mindful of is the upcoming US debt ceiling negotiation that likely to hit between July and October. So a clear disconnection between the two type of investment at the moment.
Earlier in the podcast, I spoke with an oil expert about the direction for oil prices. What we didn't talk about, given that we are seeing this increase, is the implication or the potential implication for inflation and interest rates. What's the market pricing in?
Yeah, very good question. Rising oil prices can affect inflation, but our central bank, RBA, focus more about the core inflation, which does not include the fuel and other volatile items. Having said that, high oil price can push up costs in areas such as transport and services that eventually feed through to the core inflation. If oil price stay high for a while, it could delay the RBA rate cut decision. At the moment, the market is pricing in more rate cuts from currently 3.85% to 3.1% by December.
The ASX, though, has had a great few months, reaching record highs recently. Was it due for a pullback, and was this just, I guess, a natural excuse?
Very good question. I would look at it in two ways, the technical way and the fundamental way. If we look at the technical side, we always look at the seasonality. Actually, so far, in 2025, the ASX 200 has exactly followed its usual seasonal pattern. So a dip in March, followed by a strong rally going into July. So if the past is any guidance, the market tend to peak around now and go through a bit of soft seasonal pattern between August and September. Before, of course, a very welcoming Christmas rally. So technical speaking, we think the market is due for a bit of pullback. But what about the fundamentals? When we look at the fundamentals, the ASX 200 is once again trading well above its long-term average, currently around 18.6 times on FY26 earnings. So what does that mean? It means it's 14% premium to the long-term average. So we think valuation is a bit stretched. The market could due for a breather. However, no one can predict exact timing of the breather, but the market does need a bit of pullback from here.
What about China? What are you seeing, and how is it influencing the market and currencies?
China play a big part in terms of the Aussie dollars. Why? Because the demand and supply of China will impact the commodity price, and commodity is one of the key factors to impact the Aussie dollars. And the Aussie dollar has recovered from the December low, but any further upside seems limited because most commodity, except for the gold, remain weak. And when we look at China, the recent data is a bit mixed. So the May retail sales is pretty solid and outperform the market expectation. However, the industrial production, the infrastructure, that more related to the property side remain below market forecast. So that in near term, it certainly help the like of copper in terms of Chinese consumer consumption. However, that continued to drag down the price of iron ore and coking coal. Last week alone, we've seen quite a few market downgrade on iron ore price expectation. Again, it's all about the bottoming of the China property market. So until we see a stronger and more stable commodity prices, it's hard to expect a big rally in Aussie dollars. So OI will be on late July. There will be an important Chinese meeting, Politburo meeting toward the end of July. I think the market will closely watching it.
There's a lot of changes happening at the ASX recently. I noticed last week it changed its logo, so it's going over a bit of a branding exercise, right? But also some technological changes happening too. So not necessarily will impact most mum and dads, but traders like you especially. So changes in the way it deals with pre-open bids, replacing the old staggered opening system, and also changes at the end of the day. Can you tell a bit more about that and how it affects traders? And was it a smooth change today?
I think it will become a more fair system. The reason I say that is over the past 26 years, when I look at the ASX opening, is always following the alphabetical order. So if I look at the stocks start with W, such as Woodside, I will have to wait till very end of the opening. Now, the new opening will mean all the stocks will pretty much open at the same time, which I think would become a bit more fair. And also in the closing time, what more important is it's sort of extended from 411 to 421. What I mean is some of the trade, limited trade though, can be executed at the later of the trading day. So I see this as a good change. And so far, things appear to be quite smooth.
And finally, what are you telling your clients right now, and where do you see the opportunities for investors?
So with the stock market valuation look a little bit stretched, and July often marking a seasonal high, I think it makes sense to keep a bit of cash on the sideline and take advantage of any market volatility. Having said that, the market is still expecting earning to go higher for the next couple of years. So keeping a long-term investment mindset is important for investor.
That is Raymond Chan there from Morgans. Don't forget, if you enjoy the podcast, to give it a rating or review on Spotify and Apple Podcasts, and to click subscribe. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.